Welcome to the Wealthy Life Podcast. I'm Sybil Verch, and today we're going to be talking about mortgages. It's one of the biggest financial decisions Canadians make. It's an important one. So we're going to cover everything you need to know to make sure you make a smart decision before you renew or take out that mortgage. With me today is Kendall Gross, president of Island Savings. Kendall, welcome.
Thanks, Sybil. I'm really happy to be here.
Well, we got to start at the basics because I hate to say, not everybody even knows what a mortgage is. How would you explain that?
Well, in its simplest, a mortgage is a loan that you get from a bank or a credit union or a broker to buy a home.
Yes. And your house is used as collateral on that?
Your house is used as collateral, but your income is really what qualifies you for that mortgage.
So what do people need to be aware of before they qualify and to know how much they qualify for?
That's a really good question, actually. In Canada, we use what's called a stress test. So the rate you might be getting on your mortgage is not necessarily the rate that's used to qualify. It's a higher rate that's used to qualify. So you really have to take that into account. And that's really just meant to protect consumers, to protect us against those shocks, those financial shocks in the system that could be problematic.
Yeah, we see a lot of people house rich and cash poor, and you don't want to overdo it and borrow more than you can realistically afford to pay. Yeah. Speaking of which, we've gone through a very interesting time with interest rates. Yeah. And interest rates a few years ago were so low, a lot of people locked in to take advantage of that low rate. But of course, those mortgages are all coming up for renewal over the next year and two. How does that affect people?
Yeah, they are. That's a great question as well. If you think about those rates, as you said, they're back just after the pandemic. They were really low, ultra low in some cases. How that affects people is that as their mortgages are renewing today, the payments are going to go up. In some cases, it could be 10, 15, 20% higher than they were when they originally took that mortgage out. So it does have an impact on day-to-day spending, on your finances, on your budget.
Now, if people who are used to living paycheck to paycheck, a 20% increase in your mortgage payment, which is probably the biggest single monthly expense most people have, is maybe unaffordable for some. What are some options that they may have to reduce those payments, or can they?
They can. There are a few options for sure. If there's other debts that they have, credit card debts or other loans, you can look at refinancing that all back into your mortgage at renewal time, which will lower their overall payments. Sometimes that's enough to help out. There are some consequences to that. You have to understand there's some implications from the amount of interest you're paying. But if it's a cash flow concern, that will certainly help out.
Yeah, let's talk about that a little bit more, because you've got credit cards typically are up close to 20% interest. Yes. Even if people are making the minimum payment only, they're going to be racking up over the lifetime of their debt, hundreds and thousands of dollars of debt.
Right.
So I think what you're saying is maybe refinance and pay off all that other debt. You won't have to then make those monthly payments.
Right.
It'll now be all combined into one. So even though your mortgage payment's a bit higher, overall, all your monthly payments may come in a little bit lower.
Yeah, absolutely. And you are saving that 20% interest on the credit card. You are taking that debt though and amortizing it over a longer amortization. But again, if it's a cash flow issue or you need to free up some budget to make sure those payments are being made, it's a valid solution for many.
Now, amortization schedule, how can that help?
So term and amortization are the two aspects of a mortgage to consider, and you can think of it like a book. The term is like a chapter. It's usually it could be a 5-year term or a little bit less, and that's sort of that contract that you're in for that period. Amortization is the whole length of that mortgage, and so kind of the rest of the book, if you will. And so from an amortization perspective, if you're financing debt into it, you'll end up paying that interest over that whole amortization.
What's the average amortization period on a mortgage?
It can be as high as 30 years. Average, it'd probably be 25 or less, depending on how far in it you are.
Right. And what should people be considering before picking an amortization schedule that's suitable for them?
Well, I think this is where you get into a good conversation with your financial advisor or your mortgage professional, because it's really what you want to consider are your goals for that mortgage. Do you want to pay that mortgage off sooner? Do you want to use it to purchase maybe another property? So what are those goals? And that will often dictate how long you want to have that mortgage for or what that amortization period is.
Oh, you touched on something really important there. Well, I think a lot of people want to have their mortgage paid off by the time they retire. So depending on how many years that is, it's nice to line those things up. But using it to buy another property, or with this housing shortage that we're in, a lot of people are building garden homes or putting suites in their houses. And not only is that addressing the housing shortage issue, but it's creating some additional cash flow. So if you're having trouble paying your mortgage, maybe you can use that to get some extra income coming in the front door.
Yeah, absolutely. It's a really, really often used strategy from a perspective of mortgages and finances. But you're taking the equity out of the home that you've gained through paying down your mortgage, and you're using it to create another income source. So it's a solid strategy.
Now, the qualification for how much you can borrow is still comes back to that income.
It does.
That debt servicing ratio, that magic formula.
It does, yeah. There's, to be really technical, there's two ratios that lenders will look at. It's your gross debt servicing ratio or total debt servicing ratio. Gross debt servicing is 39% and total is 44%. And all that means is, from a gross debt servicing perspective, all of the payments that are going towards the house, the property, the taxes, the heat, the principal interest payments, that amount relative to the amount of income you have. Total debt servicing looks at all of your debt relative to the amount of income that you have.
Right. They want to keep that below that 44 or 39?
39 from a gross perspective and 44 from a total perspective.
Okay, yeah, which is smart because you want to make sure people still have enough money left over to put food on the table and cover their transportation costs and maybe even live a little bit, have some fun in life.
That's the whole idea, yes, exactly.
So when people are refinancing then to take out more money, so increase their mortgage amount to build a garden suite or put a suite in their home or buy another property, is the income generated from those other properties, is that also counted as part of that debt servicing?
Yeah, absolutely. That income will count towards it. And depending on the lender, will determine how much of it can count. But yes, that's exactly the idea.
Okay, so what are some of the mistakes you see people make when they take out a mortgage or renew a mortgage?
I think one of them is not accounting for all of the additional costs that are involved in that. So you'll have legal fees, appraisal fees, there's property purchase tax here in BC. There's a few other costs and fees that come along with it. And if you don't budget for that, it can actually be a fairly big hit. I also think some of the mistakes they make are maybe not getting advice, maybe just looking online and taking what they think is the best rate or best product without actually aligning that to goals. We talked a little bit about that, but how long do you want to have this mortgage for? How do you want to live? What are some of the things you want to do, and how will that mortgage affect that? I think is important to understand as well.
Yes.
And I think just not looking at options or getting some advice is another mistake that people do make.
Yeah, aligning to goals is quite important. I can think of a recent example. A friend of mine needed to renew her mortgage. So she went to a mortgage broker and she shopped for the best rate. And that's all she looked at. And it was great. She got a really good rate. But the problem with that is she knew she was going to be selling her house to downsize, but forgot to mention that. And the question wasn't asked. And lo and behold, 18 months in to the renewal, she sells her house and was stung with thousands of dollars of penalties in getting out of that mortgage.
Yeah.
So what are some of the terms she should have been asking about that would have prevented that?
Well, I think you want to understand how long that the mortgage term is, and is there an ability to prepay down that mortgage in part or in full? And if so, are there penalties to do that or fees associated with that pay down? I think those are probably the most important things when you're getting into that mortgage term, because that's what you're talking about is really going to sting people, is understanding that sometimes there are different incentives as well that are offered by various lenders to get into a mortgage. Those incentives sometimes might need to be paid back if you exit the term sooner than it was supposed to be. So really understanding those those restrictions and those various clauses in mortgages is very important.
And the average person doesn't read the fine print in the mortgage contract.
Exactly.
So, hopefully in listening to this today, the average Canadian will ask all these questions to make sure that they get the right mortgage for them. I also know having a feature like portability or transferability of that mortgage can help. Can you talk a little bit about the difference between portable and transferable?
Yes, really, those terms come into play if you're thinking of moving, perhaps. So you'd want to be able to take your mortgage from the home you have and move it to the new home that you're buying. That's a portable mortgage. You can pick it up, take it and set it down on the new property.
And there's no penalty because you're not leaving the mortgage.
There's no penalty as long as you're keeping it the same. If you're going to port it and maybe you have to decrease that mortgage amount because you're perhaps downsizing, there could be some penalties involved in that. But if you're just taking it across, then that really is what should be penalty free.
Right.
Again, you'd want to make sure that when you're taking that mortgage out with your lender that you talk about portability and what are all those terms. Are there any fees involved with that?
And pay down provisions. What is the average pay down provision without a penalty, or does it vary? Yeah,
I think it varies. Some institutions are 10% a year. Some institutions are 20% a year. So it just varies. Again, another detail that you'd want to make sure you check out and are aware of.
Now, what's the difference with getting a mortgage from your bank versus a credit union versus a mortgage broker or a private lender even?
Yeah, you know what? There probably isn't as much difference today as there once was. I think that credit unions sometimes they make more local decisions, so might have a little bit more flexibility in approving a mortgage or approving a specific property that's being mortgaged. Banks offer really great convenience, and they have perhaps sometimes more mortgage options, more mortgage terms to look at. Brokers or private lenders, in my mind, it might be rate that's different. Overall, I think within all four of those, you're going to get a good product, and it might just come down to rates and terms that are different.
Right. Yeah. Rates and terms are really the two most important things to look at.
They really are.
And when you look at private lenders, I think at least in my experience, they charge a bit higher rate.
They do.
I see it on the flip side. So we see people investing in private mortgage companies, and they're getting, great returns, maybe 8%, depending on the time that they're investing. But there's a catch. I always say, well, if you're earning 8% on a mortgage investment, the mortgage company's making money. So what's the borrower paying? Probably 12.
Right. That's the flip side.
That's the flip
side.
Right?
Yeah.
So who would go and pay 12% on a mortgage if current rates are 4.5 or 5 or 4? I think it might be higher risk in some cases.
Yeah, for sure. There's really four things that say a credit union or a bank or a mortgage broker will look at. It's income, so your employment income or other sources of income to make the payment. It's how much debt do you have? Again, back to those technical debt servicing ratios. Do you have lots of credit card debt or other loan debt? It looks at how much you have for a down payment and what your credit history is. And so private lenders oftentimes will look at loans that perhaps there's not a good credit history, or there's not a lot of down payment, or there's not a lot of income. They'll be able to offer you a solution, but to your point, that might come with a higher rate or other fees.
Yeah, but it's in some circumstances it's worth considering, especially if it's only just a short-term financing need.
Oh, for sure. It's a solution for some, for sure.
Yes.
Yeah.
So when we think about mortgages, I think about four different types, really. I think a first-time mortgage, or you're taking out a mortgage to purchase a property in the first place. You're renewing your mortgage.
Yes.
So because every 3 years, 5 years, whatever term you had is going to renew every year for the whole amortization period. Refinancing, because maybe you want to consolidate debt, you want to take out a little bit extra money to maybe go on a trip. I wouldn't recommend that, but doing that to invest in something, that might be an okay idea. And then there's even something called a reverse mortgage.
Sure.
What do you know about reverse mortgages?
I think that reverse mortgages they absolutely are right for some people based on where they're at in their stage of life. Essentially, it is what it sounds like. It's a reverse mortgage where you're actually taking the equity back out of the property to use for your life, for fun, for travel, for investment. And that's building up against your mortgage continues to build, and there's you're charged a fee on that. So whereas a traditional mortgage, you're taking that loan out and trying to pay it down, it's the reverse.
It's the opposite.
It's the opposite, yeah.
I mean, I guess the nice thing for people who are maybe later stage in life might use that to pay for care costs or help their kids out and don't want to make the monthly payments because of the cash flow.
Yes.
But I know that the interest rates are generally higher in that than they would be on a conventional mortgage.
Yeah, again, a product that would suit a number of people today, like a lot of people. But yeah, again, you just have to understand those terms, those famous terms that we talk about. Right?
Well, let's go back to the renewal piece, and then I want to talk about first-time home buyers. So when we talk about renewals, what do people then really need to make sure they do? So they've got a mortgage with a financial institution. Do they shop around? Do they stay with their existing lender? And what are the pros and cons of each of those?
You know what? I think nowadays people need to, number one, start planning and thinking about that well before the date of renewal. I would even suggest to you 6 months before, go in, talk to your lender, and absolutely compare, look around and see what else is out there. I think that that's a fair thing to do nowadays because like we talked about earlier, in many cases, your payment's going to go up. It may affect your budget. So it's an important thing to go in and have those conversations, understand what your options are. Some lenders will actually early renew, which for some makes a lot of sense. But looking around and making sure it suits your goals or what you want to accomplish, do you want to go on a vacation to your point, or do you want to purchase something? Like, what does that look like? Do you have children that are going into university? Renewal time is a great time to reassess all of that. And I think if you do that before it renews, you have that opportunity to really look at different options.
Yeah, see how it fits into your short-term and long-term goals and objectives. And then make sure you ask the questions about the rate and the conditions. Exactly. And hopefully that still aligns. An amortization period. Do you want to lengthen? Do you want to shorten? Renewal time, you get to redo it all again.
Do all of that. If you've got debts there, that's when you can renew, but also refinance at the same time to just help that cash flow out. It's an important time.
So if you're doing that with the existing lender, then do you need to go through the appraisal process again, the legal process again, or does that
what term are we going to go into? What's that rate?
And then if you are making a move, then some of those expenses may come up.
They will come back, because most lenders won't move a mortgage in without doing the appraisal, without charging those fees.
Right, and the legal fees. Now, if you're refinancing and taking out more money, does that trigger the cost for an appraisal again?
It depends on what the loan to value is. So if you only have about 50%, as an example, 50% of the value of your home in a mortgage and you want to just take out a small amount, sometimes lenders won't need the appraisal. They can just work off of assessment or assessed values. If it's a larger amount and you're pushing that loan to value limit up to 75 or 60, 70, 75%, then you probably will have to get an appraisal.
Right.
Besides that, though, there will be legal fees because you're re-registering things on title. So
it's just something people need to be aware of. And I think some lenders sometimes have promotions on where they'll cover those costs or give you a cash back that you can apply against those. Well, let's talk about that, 65% versus 75%, 80%. What's a conventional mortgage versus a high ratio mortgage? And when do they come into play?
So depending on that loan to value is where you get a conventional versus a high ratio mortgage. If you get over 75 or 80% loan to value, those loans, lenders will ask that they're insured through CMHC. As an example, there's agents, so we need mortgage insurance on it. Those are high ratio mortgages. Anything below that is considered conventional. We don't require, or lenders won't require insurance to basically protect the mortgage. Essentially, you can do it based on the value in the property.
And the insurance is another cost, and it's not cheap.
It is not.
So it really, first-time home buyers maybe only have to put 5% down, I believe. And then the cost of the insurance comes pretty close to a good chunk of that already. So
it does, There's various premiums that are different amounts depending on on how much insurance you're actually getting, but it can be a cost. Back to, when you're taking out that first mortgage and understanding all the costs that you have to do besides just the mortgage, that's another one you have to think about if you're a first-time home buyer.
Well, let's talk about first-time home buyers. You've got kids?
I have 3, yes.
Yes? How old are they?
22, and I have twins that are 22, and then older guy that's 25.
Now, I've got a 23-year-old. Are our kids going to ever be able to afford to buy a house?
They can, for sure. I think it's going to take a lot of planning and some discipline, but it's not out of the question at all.
So what tips do you have for first-time home buyers?
Well, there are some programs that I think we should be aware of. There's a new first home savings account option that banks will offer, where as a first-time home buyer, you can save up to $8,000 a year tax-free. It can grow in an investment, and when you pull it out tax-free as well, which is a great benefit. There's also first-time homebuyer plans through the federal government or through your RSP that you can withdraw funds from your RSP to put towards a down payment. You do have to repay that over 15 years back into your RSP. But those are just 2 programs that really help gather a down payment.
I'm a big fan of both of those programs, especially that first-time home savers account. Which is fairly new, but $8,000 a year can go in, creating a tax deduction in the year you put it in. It grows tax-free, and then you can pull it out tax-free at the end as well.
The key is you got to open it up to get that benefit.
You got to open it up. You're right.
You got to open it up to get the benefit.
Yeah, very different than an RSP. You start earning contribution room when you have earned income, employment income.
Tax-free savings account. You get that room, but
and if you don't use it, it carries forward. Right. But a first-time home saver account does not start accumulating room until you open it.
That's right.
So everyone should open those accounts.
Yeah.
First-time home buyers.
You can. I think it maxes out at $40,000, but you can keep it for 15 years. You can have it for 15 years if you're saving to.
Well, that's a great way to help people get started. Now, what about gifts from mom and dad or grandma and grandpa? Yes. How often does that come into play?
We see it all the time. It's just a fact of life nowadays, and it's awesome that parents and grandparents have that ability to provide some of that fun, some of the down payment, and we see it as gifts, we see it as loans, but it is another way to very quickly get funds for a down payment to get established in a new home.
Which is great, because I think the home is a good investment compared to paying rent. It's like a forced savings plan. The equity goes up over time. Of course, not all markets it makes sense. Every situation is a little bit different.
Yeah, that's right.
Is there any other final tips you have for people on mortgages?
I think that you said it earlier, Sybil, and we've been talking about it. Your house, your mortgage is, for most of us, the largest part of our financial plan that we have. And we need to look at our mortgages in terms of our risk tolerance, in terms of our goals. What do we want to accomplish? When do we want to be mortgage free? And what type of flexibility do we have? And to get to that, it's really important in my mind to sit down with a professional, with a mortgage advisor, with a financial advisor, and really explore all your options, and compare, and you'll come up with something that's really great.
Kendall, we've covered a lot of ground today. So the key messages that I have heard is make sure you sit down with a professional to have a look at all of the different options. You want to look at the rate. You want to look at the conditions. You want to look at how the mortgage ties in with your overall goals, objectives, and your financial plan so that you can make the right decision on your mortgage. Because the mortgage is probably the biggest financial decision most people make. You want to get it right.
You want to get it right, absolutely.
And the other frequently asked question we get is, but how much do I qualify for? Because that's going to help drive a lot of those other discussions. I understand that you have a calculator on your website. Where can people go for that?
Yeah, you can go to islandsavings.ca and just follow the prompts through the borrowing section on that website, and you'll be able to find the calculator for how much you can afford. And there are some other calculators there as well that I think will help you out as you get through this decision.
Well, I love calculators, so I hope everybody else does too. Kendall, thanks for being with me today.
You bet. Thank you for having me.
As always, please seek independent professional advice before taking action. We are here to provide information to help you learn and ask the right questions to make smart decisions so you can live the wealthy life.